From Deloitte Tax, welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business developments. I'm Carrie Falkenhayn, your host for Tax News and Views, and today's discussion is the kickoff of our new series on Pillar 2. Pillar 2 is part of the OECD Inclusive Framework, and it'll have major implications for multinational corporations around the world. Today, we're going to cover some of the Pillar 2 basics, and we will build on these concepts in future podcasts. Today, we have two special guests. First, we have Bob Stack, who has talked with us in the past on OECD developments, based on his experience being the former Deputy Assistant Secretary for International Tax Affairs for the U.S. Treasury. We also have Ryan Bowen from Deloitte's Washington National Tax Practice. So thank you, gentlemen, for joining me today. And Bob, I'll start with you. So Pillar 2 has many different components. It has an income inclusion rule. It has a qualified domestic minimum tax, as well as an under-tax profits rule. Can you briefly just help our audience understand how these three concepts will interact with one another in connection with Pillar 2?
Yeah, sure. And I think for the audience, you're going to hear this stuff called Pillar 2, or sometimes the GLOBE rules. GLOBE is an acronym that stands for something I can never remember. So that's at the high level. And then it's got these three moving parts. The goal is to be sure that a multinational pays at least a 15% minimum tax in every jurisdiction in which it has operations. So you can think of each of the three rules I'm going to describe as a way to achieve that goal of making sure that if there's a pocket of operations in your multinational that doesn't have a 15% rate, somebody's going to get to tax it. So the first one is this income inclusion rule. It's a little bit like our GILTI in concept, but not in design. Because what it really does is it says, hey, at the parent level, for jurisdictions that have an income inclusion rule, look down your chain. And if there are jurisdictions where you have less than a 15% effective rate, boom, you pay a top-up tax in the top co. So let's say the effective rate in a jurisdiction is 10%. You're going to pay 5% of that income up in the top co to top you up to the 15. But of course, not everybody is going to necessarily have an income inclusion rule. So they have this other rule that says, well, if the top co isn't going to have an income inclusion rule, we still need to give some jurisdictions a way to pick up undertaxed income. And that's called the undertaxed profits rule. So think of a case where maybe Bermuda's at the top and it doesn't have an IIR and it has a haven sub that has a bunch of income. Well, the parent doesn't have an IIR. It's not going to pick it up. So what the UTPR does, the undertaxed profits rule, it lets the brothers, sisters of that haven sub pick up the tax that is otherwise going to go untaxed by that parent that didn't have the IIR. And then finally, countries are going to say, well, wait a second. If I have income in my jurisdiction that isn't taxed at 15, why would I let the parent get it or the brother-sister entity? So we expect countries to do qualified domestic minimum top-up taxes. In other words, you pay the 15 to us, the jurisdiction where you fell below. Those are the three moving parts: IIR, UTPR, QDMDTs. We expect the IIRs and QDMDTs generally around the world to go into effect in 24, and we expect that UTPR to go into effect in 2025, generally around the world. And so we have to watch as all the legislation flows out. So those are the three moving parts to just get your bearings in Pillar 2 and GLOBE.
And Bob, you mentioned the timeline, right? And we've been talking to you and hearing about Pillar 2 for quite some time. So is this really happening now? And what's the state of play around the world? And expand a little bit more on some of the timeline that you described earlier.
Yeah, my experience was that for a long time, U.S. companies in particular were kind of either wishing or hoping this would just go away because it has a great deal of complexity, et cetera, as you'll probably get into on future podcasts. But once the European Union adopted unanimously a directive at the end of 2022 that said, yep, we're doing this in Europe, and all the EU countries have got to enact their legislation during 2023 to put it into effect on the timeline I suggested, 24 for the IIR and 25 for the UTPRs, then everybody started to say, whoa, this is really going to happen. And I just heard on a different call I was on, over 40 jurisdictions have already said, yep, we're going along with Pillar 2 and getting ready to do their legislation. So this is happening. And one caveat, this happens to US MNCs, whether or not US Congress does anything about anything. Because the way these rules work, if you think about it, is the impact is on your affiliates in foreign jurisdictions, and even with respect to perhaps low taxed income in the US. So it's happening. Congress doesn't need to do anything, and companies are beginning to see that and starting to prepare, as we'll talk about.
So Ryan, maybe I'll turn to you. And these rules sound extremely complicated. One of the things that we've heard about are simplified safe harbors that might help taxpayers ease some of their compliance burden for the next few years. Can you talk briefly about that?
Sure, that's right. So in December of last year, the OECD put out guidance around what they're calling temporary safe harbors. These safe harbors are available for the first 3 years, effectively, that the Pillar 2 rules will apply to companies. And the intent of these rules is to sort of ease the transition into the Pillar 2 rules by reducing some of the data needs that many companies are finding that they face as they start to maybe gather calcs or ask their tax department to start assembling what looks like Pillar 2 information. And the way they accomplish that goal is by leveraging data that's in the country-by-country report that companies are generally around the world required to put together. There's a little bit of nuance there that country-by-country report has to be what they call a qualified country-by-country report, which is in turn based off qualified financial statements. And so there is a little work to do there to make sure that your CBC report is sort of up to snuff under the safe harbor standard. But generally, assuming that you have a CBC report that meets that test, you can leverage one of 3 options to meet these safe harbors based on either a de minimis income threshold in a jurisdiction, a routine profits test in that jurisdiction where your CBCR income is below percentage of your tangible asset value and employee payroll costs in that jurisdiction, or finally, what they call the simplified ETR test. And I think most of the clients we've talked to have really focused on that simplified ETR test. This rule kind of eschews the more complicated globe calcs and again, utilizes the CBCR income as the denominator for assessing whether a jurisdiction is above 15% in 2024, 16% in 2025, or 17% tax rate in 2026. The numerator for that fraction, again, not using the complicated definition of current tax expense or deferred tax expense from the Pillar 2 rules, but rather pulling current and deferred tax expense right from the financial statements. So the idea is that companies have that data today, both in the CBCR report, financial statement, tax expense. They can run these tests with minimal sort of systems to build right from the starting point. And for a lot of clients, I think this looks like it will provide, a meaningful benefit in terms of saving some of the work that you need to do in those first few years of Pillar 2.
Got it. And so far, what you and Bob have been describing are the global rules, right? But are there special issues that US-based MNCs are specifically focused on?
Definitely. And Bob mentioned a bit ago about the UTPR potentially applying to US-based income or US income that our domestic affiliates earn here. And you might think, well, if the US has a 21% effective rate, we add state tax to that. Well, when might my US income be low tax? When might it have a Pillar 2 effective rate below 15%? And one of the key drivers of that is the treatment of non-refundable tax credits in the US. And so for quite some time, especially since the rules came out even, there's been a fair amount of concern and political pressure, frankly, on the treatment of our tax credits here in the US, because the way the Pillar 2 rules are designed, non-refundable tax credits are treated fairly unfavorably compared to what the rules call qualified refundable tax credits, whereas those refundable tax credits are treated as an income item, so they go into the denominator of the ETR fraction. The non-refundable tax credits are just a reduction to tax expense, and so they come out of the numerator of that tax fraction where the impact is much greater, and again, puts pressure on the US rate. And so I think there's been quite a bit of concern based on how many credits we have in the US that meet that definition of non-refundable tax credit, just the sheer volume of credits that clients have here in the US, that those can start to put pressure on your US rate. And from a political perspective, really start to claw back some of the benefits that I think Congress had intended to push through these credits. And so there's a concern there that maybe some of our incentive regimes won't work as planned if that credit just pushes the US rate down below 15% and gets topped up in some foreign jurisdiction.
So, Bob, maybe what are your thoughts around the most challenging aspects of complying with Pillar 2 for US-based multinational corporations?
Yeah, as I suspect, as people dig into these rules, they're going to realize that unlike your normal tax rules, you don't start with, let's say, tax concepts. You start with your financial accounting standard. So we're starting with book, but we're not really using book. We're going to make a series of complicated adjustments to book. And then taxpayers have a bunch of elections they can make. And so everyone is realizing this is really a third set of books based on really complicated rules. It's not enough just to go to my tax accounting people and say, what's the gap treatment of this or that? You now have to layer on the complicated rules that Ryan and I spend most of our day job looking at over those financial accounting rules and make a variety of adjustments. And then taxpayers have to make some elections and have some options for elections. Then you get to this issue around, do I have the data, to do it? One way I talk about this to companies is you can take two approaches to this. And on the one hand, you're going to look over your org chart and you're going to say, do I have pockets? What are the likely pockets of income in jurisdictions that might fall below 15? And so quick and dirty, you might say to yourself, I'm pretty much in high tax places and this may not be a big deal. That's kind of the substantive. Will I owe any money? But then there's the compliance. Now I have to walk through these rules in every entity in every jurisdiction around the world to demonstrate that I have that greater than 15. And I think that's the surprise for folks is the compliance element using what I kind of describe as these third set of books.
And Bob, you and Ryan both talk to clients on a regular basis, and you maybe alluded to this early on in your comments, but what would you say is the general state of readiness of US-based MNCs with respect to complying with these rules?
Yeah, I had a client the other day ask me kind of on a scale of like 0 is like I haven't even read them yet, and 10 is I'm all set to go. I can assure the audience no one is near the top end of that scale. Everybody is trying to get their head around how the rules work, really going back to the very basic concepts. You have to realize it wasn't until December of 22 that the EU said, yeah, we're doing this. And the world sat up and said, this is coming at us. And we might need to estimate some taxes as of 24. So I would say the general state is, somewhere between panic and grief and let's get ginned up to be able to participate in this. But there are very few companies out there that are just kind of ready to go or even close to that.
And Ryan, what are you seeing companies do to prepare?
Yeah, I think most clients kind of fall into two buckets in terms of preparing right now, and these can coexist with one another. I think the first is getting ready for safe harbor because it is simpler, but at the same time, you need to meet it in the first year if you're ever going to meet it at all. And so it puts some pressure on making sure you're going to get ready to meet it in 2024. And so part of that is assessing historic CBCR data to assess, does it look like we're going to meet this based on historic trends once the rules come online in 2024? That's kind of the first step. Maybe in parallel to that or separate from that, depending on the client, is getting into the modeling. And I think there's a lot of value to modeling, not just in terms of, like Bob said, assessing, am I going to owe any money? But just the very process of modeling teases out some of the data gaps as well. When you go through and assess or try to put in info to construct your model, that will show you where your data weaknesses are. What do I not have an answer to? What are the Pillar 2 rules asking for that I can't find in my tax department? And it isn't really until you sit down and try to model these things out that you can really tell maybe where some of those weaknesses are in your data today. So I think the modeling serves as a valuable tool, not just for assessing where the tax impact is going to be, but also helping prepare from the data, the compliance side, and starting to pull together the data you ultimately need to fill out your Pillar 2 return.
Well, thank you so much, Bob and Ryan. Really appreciate that overview. As I mentioned, we will have future episodes that focus on some of the concepts that were discussed today. Certainly, we're going to cover safe harbors, how you calculate global income, discuss covered taxes and data needs, as well as state implications and much more. In the meantime, if people would like more information, I suggest you download the Tax at Hand app. You can find that on all the various app stores. And there you can search and find a number of global materials covering Pillar 2. You can also connect with Bob and Ryan directly via LinkedIn, and we hope you tune in here for future editions. In the meantime, thank you all for joining, and I hope you continue to be well.